Hello, Warriors. Hello, team. Hi, Alexander. James Groom. How are you? Bran, K-Man, Ingmar, Ryan Varghese. Irrational exuberance. By the VIX. I agree. Richard Adams looks, Bran looks confused. And Sinatra, how are you? So, team, let me start off with you, Ryan. Are you here?
Ryan is just walking in. Good morning.
Okay, he walks in. Good morning, K-Man. How are you? So let's start with Euro USD down a
Yep.
little bit after making new highs. If we got back under the fib, like 109.60, would that be a warning sign that we could get some type of correction of this recent advance?
It would be if it happens, let's say today after 4 p.m. London time or tomorrow, because we're still in month end,
And that was valuable information, okay?
Okay.
If people took it seriously,
Yeah.
okay?
Uh,
Because it did give a surge the last couple days. That
yeah,
model.
it absolutely did. And the thing is that also if you look at the spikes in the euro dollar cable, the low in the dollar yen, the high in the Kiwi, despite and in combination, I should say, with RB and Z overnight, they all came around the Tokyo. We have to bear that in mind. That it seems like the Japanese have some decent month end to do, and afterwards we shied away from those bottoms in the dollar. Okay, so I
Hey,
guess
hey,
that is something that we need to pay attention to in the next couple of days. Yeah.
hey, K-Man. Hey, good morning, guys. And I
Morning.
just wanted to say, I was actually driving and trying to follow quotes as I was driving because it was right at the RBNZ time, and
Bad
it's
boy,
interesting.
Blake.
I'm sorry.
Bad boy. Looking
Yeah,
at
I know.
quotes.
Well, I keep it up like close to like my dashboard, so I'm like,
All right.
I was in rush hour traffic. Anyway, I was
Okay.
I was watching it and I was thinking the exact same thing, came in because the Aussie data came out and it was obviously year over year it was weaker, and then the RBNZ, like it seemed like it dragged it up, but it's like the dollar was moving down against pretty much everything. And I
Mhm.
was thinking that as I was driving, I was like, man, it must be just some Asian US dollar selling demand at this point, so it's interesting that you point that out as well, because it
Look at
did.
where it stopped too.
Oh yeah, I'll let K-Man continue on here, but I was thinking the same thing as I was driving last night, and I didn't
Yeah.
get home till really really late. So anyway,
Great
thanks for
minds.
observing that.
Great minds, think the same great thoughts.
I'm just
But
glad it was observed and I wasn't just like imagining things.
no, no,
So
no,
Oh,
you're not
that's what you're
imagining
checking
at
out.
all.
Okay.
yeah.
It's actually two
Anyway,
days in a row, 2 days in a row where it happened on the Tokyo fixing. And this time, of course, we were already trading at a lower level in the dollar after Waller and whoever spoke. But yeah, it's now 2 days in a row where around Tokyo fixing, we put in a bit of a spike low on the dollars. Yeah, you're looking at that Aussie dollar. It's going to be important, that level at the close of the month, that 66, call it
yeah,
67 zone. It's going
because we get through that, 70 cents is viable in my view. And
Mm.
and I would love everyone's pretty bared up on the dollar now. I'm going to ask Blake to see his charts if he shows any support here. But you know, I was reading Jim Welsh, and he thought that if we took out 103, that would be a five. Doesn't mean this is a low, but it implies a correction coming from this recent decline.
Well,
Mm.
Dale, I think you have it written or you're shown there. It is the 618 retracement. We tagged it last night and bounced aggressively off of it. So
Oh, okay.
yeah, it's that lower, the second set of
Yeah,
pretty colors that you have there. We're
yeah.
at the 618 in the dollar index, and that was at
Okay.
102.55. So that could very, if the data turns like the next couple of days, that could very easily You know, we
like
have
a bad
GDP data. We
inflation
got
report. We've
well, we
had
have GDP.
nothing but good ones.
Well, yeah, we have to have decent, you know, advanced GDP and a kind of, you know, inflationary PCE data tomorrow. So anyway, sorry,
I'd love to
I'm gonna.
buy. I'd like to see a dollar bounce and to correct it and a Aussie pullback to maybe 4.5 or so. I'd be buying that, and maybe Euro 107.5 or so. Take anyway.
Wait for the FOMC.
What's that?
Wait for the FOMC. You might get your chance.
That's 2 weeks away, right?
Yeah.
Yeah, it could take 2 weeks for that to happen. So you think the FOMC will be the trigger for it, or it's going to go down into it because people might shift their expectations that the Fed might talk hawkishly with gold near all-time highs and speculation picking up in the markets again?
Yeah, I think the market's getting obviously month end stuff, but I think the market generally is getting perhaps a bit too dovish. This was my worry coming into the end of the year. I don't think the Fed are going to let go. Not on the last meeting of the year. They want to kick the can into next year and then worry about it. So I think Powell's going to be pretty hawkish, at least in keeping that term restrictive rather than sufficiently restrictive. And if that corrects some of the dovish calls or expectations, you're going to see a pop in the dollar, pop in yields. I think that's potentially your last chance to grab such a dip.
You know what? I'm right with you. That and right now it's I think it could happen. And so
Yeah.
now I'm prepared for it. So everyone that's listening is, you can prepare for a narrative in advance. So you don't have to think about it when it's happening. So good analysis. Does that include some type of bounce in US dollar yen? It made a new low, took out that low, is counting on this higher low. Obviously, I got stopped out on my full moon trades, except for Euro. I'm still alive, but we are diverging down here. This is drive 2. I don't know if it's going to need another one, but could we get a bounce here in yen? Are these important levels to you at all? 46.70?
I think it's possible. 47 was my level, and we had that first test down to 147.15 and the strong bounce up. The fact that it cracked over the fix, I don't like a level getting cracked. It went by 30 odd pips. Though we are back above it, and as you can see, that 4-hour candle before the current one held 147, so it is showing up again as a level. How high can it bounce? We've still got best part of 2 weeks until the FOMC, and a lot can happen, and this is already under pressure. I don't fancy chasing it. I think anything up towards 150 might be a bit of a gift for getting that. But I'd still take even if we were trading 145 and the FOMC gave us 147, I'd take that move. So it doesn't really matter where we are. It's looking for that upside move. But as we say, there's a lot of water to go under the bridge yet. You're right. Having a plan is fine. And people have got this plan 2 weeks before it's potentially going to happen, and you just judge it as you go along, and you get to the day, and you make the final decision.
Okay, I know I've been talking about the non-performance. Even our attendees had me ask Peter the other day why the golds are underperforming the physical. GDX, you do have a breakout now. You could call this a head and shoulders bottom here, left shoulder here. Pretty strong breakout day. So this is just beginning. So if you don't have any gold exposure in the miners, buy some and hope that it ends up being a fake breakout so you could buy more. So that happened there. Newmont, pretty strong. There are even the dogs, which have been waiting. This one I own from 3. had this kind of day approaching 200 day. And, you know, I wouldn't chase the best performing ones, but you even have things like Majestic trying to come out of it. It looks a lot like Aussie, only it's breaking out compared to Aussie. So, you know, all the gold and silver shares. Here was the one that I've been showing for months. Look at that outperformance. That's a 50% move. I wouldn't chase it here, but I certainly, if we had a dollar bounce and a metal pullback, would buy any pullback to, you know, 330 to 310 on this on Fortuna. So the miners are waking up. You may not have bought the bottom, but they're, you know, if you compare them to, they've way underperformed gold for years now. They're back to where, you know, maybe gold was 1600. So they're still cheap, even though they've made a move. If you look at them long term, they're still cheap. And this is the one that I've also talked about for a long time. It's this is a monthly, and it's a rectangle. So, you know, we've been to 10, we've been to 2. You know, I think we'll get some rally to 5 or 6, but should we ever break out over 10, okay, you're looking at $18 stock. So, you know, that might happen with like $38 silver or so.
Can I
I'm
pick
think,
your brain on this,
yeah,
Dale?
sure.
Because it is a strange thing. You know, if metals are, or precious metals are rallying, gold's rallying, why wouldn't stocks follow? Would that indicate that these moves aren't, you know, supply demand led? They're more, you know, led by what's going on with central bank policy and risk and that sort of thing. So
Well,
it's almost like
stocks,
this rally isn't built on strong demand foundations, if you like.
um, well, they're all, the stock market is rallying. In fact, since that turn, you could be long everything except maybe crude. So it's still all one market, right? Dollars weak, buy the world, right?
Yeah.
So, in fact, Bitcoin, something I want to, you know, we don't talk about it a lot, but I just want to bring up that Bitcoin was the first one to come out. Okay. Before we had a turn in rates, before we had a turn in the dollar, it was breaking out here in early to mid October, where we didn't get the, you know, the turn until late October in the market, and then a week or so later in the dollar. So Bitcoin was the first to turn, and now it's kind of struggling up here. You know, we've been diverging for a while. Doesn't guarantee you can't blow, but it's stalling. So, you know, maybe this leads on any kind of correction in S&Ps, which are very strong again today. I think they're making new highs, almost at Blake's 4,600 level, and that this will start heading down before the market. Remember, everyone was talking about there was no correlation because NASDAQ was going down and Bitcoin was going up, and they used to correlate it to the triple Qs. Well, NASDAQ made up for lost time. And, you know, it's not that they weren't correlated. It's just that there's time lags between markets sometimes. You expect them to all move simultaneously, but, you know, the picture is not that much different in the Qs.
Well, you know, Dale, maybe if I'm, and this is why I actually liquidated my Bitcoin holdings actually earlier this week. I believe it was Monday, if my memory serves me correctly. I converted everything back to dollars. The ETF should be announced like any time, and if you're a viewer and you know more about this, I think it's going to be a sell the rumor event for Bitcoin. So I that's on my radar as far as Bitcoin goes. I mean, as soon as that news comes out, I'm assuming Bitcoin's going to, you know, be closer to 30,000 than 40,000 after that. So
I'm with you.
Yeah. AJ
Okay.
says, Blake, it won't be announced until January 2024. Maybe that's it. Maybe it just kind of sits there until then. But
Okay. Anyway, just something I noticed I wanted to share, and that's about it.
All right. Well,
that I can
I'll
think
take
about
I'll take
covering.
over from here, Dale. So you know, I want to say we have data coming out in about 15 minutes.
Take it
and
away, co-pilot.
I'm gonna take it away. Here we go. Let's like not put it on
Co-anchor.
not put it on automatic here. Take a look at the euro, and euro's really, you know, finding bids, you know, ahead of the 109.60 level. So, you know, we were looking for the 109.60 level to, you know, find support, and, you know, today's low you can see is, you know, 109.69. So buyers are stepping in, you know, ahead of that. And I think that's going to be the do or die level for the euro. One of the topics, we had to film the trade-off show that I do on a weekly basis. I had to do it last night before I took off. And Ryan, you did yours. Did you do yours yesterday morning or the day? I watched it yesterday, but when did you do yours?
Yesterday. Yeah, I'll do it on a Monday.
Oh, you did it on Monday, so it came out Tuesday morning for us, and then I watched it yesterday. And you and I had the same idea, and I want to talk about it really quick because I think it's important. I was, you know, thinking that, you know, and I said this in the week ahead video, we had massive reports of massive US dollar selling coming in for end of month. I think the market was front running it, and we saw dollar weakness, you know, going into today. And, you know, the euro touched 110 far enough to just squeeze out everybody. You know, it pushed enough people out. Now, I'm not saying that it's over yet, but I think that is the risk right now. And you feel the same way. Is that correct?
Yeah, pretty much so. I mean, I saw that 110 move yesterday, and I thought I'll take a bit off my my longer term longs. Silly not to. But yeah, it's, you know, is this a last shove? You know, I would have liked it to have held 110, the break there. It is holding this that red line there, the break point there, so it's still looking pretty good. But back below that level, and things look a little bit worse off. Where we finish, like I said, where we finish after all this end of month rubbish gets out of the way is going to be important. If we finish above that resistance at 109.60s, then it's going to look strong to carry on 111s, maybe even 112s.
So you're long. You say you're long euro dollar long term. I know you guys being outside of the US, you have a lot of benefits to trading.
Yeah.
You can manage like multiple positions. We have to do, you know, FIFO. So I'm either long euro or short euro. I mean, that's it. There's no in betweens. I have to have multiple accounts to trade, you know, different directions, or you trade in like the trader funding program, or, you know, some sort of prop account like that to get around it. But where are you long euro dollar long term, and where are you expecting it to go longer term?
105. You know, that my big level when we were coming down was that 105 level. You know, multi-year level. If you go into a wider chart, leave your green line there. Oh, it doesn't extend, so yeah, it goes back miles.
Right, but where do you think the euro goes longer term?
Longer term, it's going to come down to the growth race next year. Who's going to, you know, we've been speaking about it. Who's going to cut first? Who's going to cut the hardest? On balance, you know that there's a magnifying glass on everything US and US dollar. That's why it went from 112 all the way down to you know, 104.5 or whatever, because the dollar crunches all. So we've obviously had a really strong move up. It's broken the trend. We're above the 61.8 fib of that move. Can it go all the way back to 112? Yeah, of course it's possible. We're 200 pips away. But I think it's the higher we go, the tougher it gets. You know, it's like climbing a mountain. The higher you go, the less air there is, the harder it gets. And I think once we get through the last central banks this month, then it's open season. I wouldn't care to guess where the euro goes into next year.
Gotcha. Well, nice trading. I great job, well done. And K-Man, I want to talk to you really quick about Asia. I saw you were when I got home last night, which was really late for me. I mean, I got home after the time I usually go to bed. I saw that you were up around in Asia, making comments, and I didn't get a chance to read everything. I was so damn tired. But because this damn games are like an hour away at like late at night. I noticed the Aussie big rejection, the 618 retracement, channel resistance, inflation year over year came in worse than expected. That is very easy to see why we rejected where we rejected. The RBNZ not as I didn't get a chance to read up as much on the RBNZ, but we had this push above the 618. Must have stopped everybody that was short Kiwi, through here. We rejected it. We've come off. The daily candle still has a lot of day left in it, but not looking so pretty. What happened during the RBNZ that you saw?
Well, it was more hawkish than most people expected, because they're leaving some sort of a hike on the table, and also saying that they're still worried about the inflation. It was definitely more hawkish than most people expected. The thing is that we also know about Orr that he is capable of doing 180 between two meetings, from one meeting to another. So yes, we had a visit above 62 on the Kiwi dollar. Again, that was all around the same kind of time that was happening. I've got like really pretty big resistance anywhere between 62 and a quarter and 62.60. And I also would like to mention the reaction that we saw afterwards. Whatever happens next, okay, because we are still in full whack month end. So we can revisit those levels, even go and test those big resistances. But if the month end is still like if they still need to sell a massive amount of dollars,
sure.
But I'm starting to find those post-fact reactions relatively interesting. Like we went to see the high on a new high on the euro dollar. We did a new high on the cable, new high on the Kiwi and the Aussie, and then afterwards it just comes back slowly to the levels where we were before. So that makes me think that we may be X more month end to be done. The reaction starting to be like, okay, this may be just enough for now,
Yeah.
But basically, yeah, I mean, or I was actually expecting a hold, but a dovish, kind of a more dovish hold. And most of the market was seemingly expecting that as well. And but they clearly leave the door open, although they acknowledge, like everybody else, data and stuff. But yeah, they for this round they were still more hawkish than expected. But the reaction above 62 may be a bit telling for me.
Yeah, and and it's interesting. You're just pulling up the Aussie Kiwi. First time I've looked at it since yesterday. Like I said, I got in really late, but we completed the triangle basically to the pip. Well, maybe
remember yesterday.
Shy.
Remember yesterday we were talking about it. Exactly the opposite happened, because we said like, imagine a sticky inflation in Australia and a dovish RBNZ, and exactly the opposite happened.
I know, and I was, and I was sitting there like as I got to the football or soccer game, I was like, well, I was going to buy the Aussie Kiwi if we were above the 618. I was like, okay, I'm ready to buy it. And then, obviously post reaction, I'm like, well, I guess I'm glad I didn't get suckered into that one.
Yeah, but lucky enough, I was long Aussie into month end, and then yesterday that CPI was like, and then and I was up at the time when everything happened and Tokyo fixing, and so I decided just to take it off because that level just up in the high 66 is big enough to respect right now, right?
Yeah. Well, hey, let's turn our attention over here to the S&P, because the S&P, as far as I'm concerned, we are really probing some very key resistance. There's a good chance that we can take out new highs for the year. today. I mean, look, I mean, we're grinding right into this 4,600. I think the 4,610 level. You know, Dale, you know, it's been a grind, right? And the pullbacks have been very minor. And you look at the channel that we've had all week, and I had to remove it just because I was doing some more micro analysis, but you can see that channel's still holding.
Yeah.
You know, it's pullbacks have been minor, not giving anybody an opportunity to cover shorts, not giving anybody an opportunity to get long. And that's problematic, you know, and I mean, you're going to start getting the market chasing above this 4620. What are your thoughts here?
Well, till today's action, I was thinking it wasn't making much hay out of lower yields and a weaker dollar. But pull up the 4-hour.
Yeah. Okay. I'll get back over there. Hold on. I was just I thought you were going to
What's that, the
go
weekly?
over to yield. So here we go.
All right.
Yep.
All right. So first new high, shade under 70. It's been diverging. Maybe we test the top of that channel. But I wouldn't be getting long. You know, I'm going to be doing an interview later today, and the theme is going to be don't get FOMO, okay, on everything. That, you know, be patient and wait for setbacks. You know, look for a rally to sell in the dollar, look for a pullback to buy in the bonds. Your bullish stocks, whether we go to 4,600 or not, I still think we're going to correct this advance. So metals, same thing. Wait for pullbacks. If these markets keep going, you know, we have a crash in the dollar and gold just breaks out over 2074, so be it. But I think the important thing for people to know right now is, you know, if you're not long some of these markets like you're talking, the S&Ps, you feel like you're missing everything. So
Couple of things in the chat room. Ryan, you just asked, is I'm sorry, you said the GDP expected to rise 5% versus 4.9 in the flash number. High bar or more surprise? I think that's a pretty high bar, right? So if we reach that number, it's a high bar, right?
Yeah.
and that's going to be impressive.
Yeah, very much so. I think
Right.
you know, the 4.9 was impressive when it first came out compared to 2.1 in Q2. If it blasts through 5%, but blimey, I don't know what's going to happen. You might get your dollar rally then, Dale.
Right. And hey,
can't
a
get
couple
into
other
the malls. People are parking miles away to get into the malls. It's amazing.
Couple quick things before we head out. I do want to point out that the crude oil market we talked about it the other day. You know, if you want to be long down here at $74, this is your place to be long. We have a nice little inverted head and shoulder pattern trying to play out in crude triangle pattern to the upside. Looks like we can come back and challenge maybe this descending trend line that you see here. You know, that's one thing that could weigh on risk. You know, if we start to see, you know, crude oil make a move to the upside, you know, maybe people take a look around and go, hey, wait a second, that's inflationary, not deflationary. So, which would be fighting some of these deflationary numbers that we've been seeing, whether in Australia or Germany this morning. Just little heads up regarding that. Now we do have advanced GDP data coming out. I'm going to get ready for it. But real quick, Ryan, what are your last minute thoughts before we go into this data?
Last minute thoughts. Given that the dollar's under the cosh, any rally that we get on good numbers likely to be hit. So potential opportunity here because it's Q3 data. It's not going to change anything. But if the algos react to a hot number, I might be looking at that for a little stamp on the head.
All right. So you're going to sell into any dollar strength. K-Man, what are your last minute thoughts going into data?
Yeah, roughly the same for now, but picking the currency well, I think stuff like the cable is still a bit, and probably dollar yen relatively offered around 47.75, 40, 48 right now. I wouldn't touch the euro though.
All right. Very good. Okay. So we have the dollar index to the left here, S&P right here. These are all 15-minute charts. And 10-year yield over here to the right. Data should be upcoming in about 10 seconds. You see all the GDP data here on Data Flash that comes in, with ForexAnalytix, if you guys are subscribers there. Here we go.
5.2. Hot.
What? Oh, Nelly.
USA.
Wow. Let's see. How about the revisions?
Really not a lot of movement.
No, stocks love it. I mean, the dollar
It's
just
soft on consumption, 3.6 versus 4% expected and prior.
Did nothing
so
to you, the 10-year.
Yeah, I mean, 10 years just sitting there for now. We'll see. One thing I do want to point out about like the 10-year, and just really quick, you guys need to see this just because I think it's so important for the move that we're seeing in yields and why yields might continue to come down. And I think Ryan's really onto something here. If you take the 10-year, we have an inverted head and shoulder pattern. We're back above the previous lows back in October of 2022. It's going to be tough sledding for the dollar to move higher when yields are moving down like this, and you got to break out in the bond market. And you can see even the euro's getting a lift right now. So dollars being sold after that data. Any comments, K-Man, for that?
Prices are a bit lower, consumption spending a bit lower. No, I think we are just get whatever number out and sell more dollars. It seems to be the way in this market right now.
Ryan's
gotta be really,
right.
really careful because those finally the short end of the curve has really started to catch up with the long end, and that's likely going to keep the dollar under pressure as well.
All right. Well, thanks, guys. I want to say really appreciate you being here. Thanks for the updates. Remember, catch Ryan and K-Man on the Flow Show. It's a free show usually when I'm sleeping and Dale's sleeping, but if you're trading during European hours, you need to be listening to the Flow Show. You can find it on our website. You can find it at a bunch of different locations. Whoops, that wasn't where I wanted to go. There, it's on the webinars tab. You can find it here. It is a free show. Listen and catch these guys. Dale, have a great interview, and we'll see you guys tomorrow. Tomorrow we have the PCE data, which is going to be a market mover, and it's going to be end of month. So big stuff. Thanks, guys.
To be in the know, catch the Flow Show.
There we go.
Boom.
And this is for you, Ryan. Climb every mountain. Your mountain analogy with the markets, anyway. That's the end of Sound of Music for me and Broadway, and I get to talk to Michael Kramer. Michael, please unmute, and welcome back to F.A.C.E.
Hey, Dale, how are you? There's a fire alarm going off in the background here, so I don't know.
Wow.
Yeah.
Right there, what, on the beach? There's is it in the fire pit or what, Michael?
Yeah, it keeps me warm on this 27-degree morning.
All right. Well, Michael, great to have you here. I went through your stream.
Yeah.
You have anything, any charts or anything you want to share? I'll just put up some charts.
I can share my screen, but I don't have anything specifically. I've been actually sort of slowing down on Twitter a little bit. It's getting to be a little bit too much for me these days.
In what way?
I don't know. There's just a lot of stuff going around on the broader feeds that I find to be super annoying, and I think the comments are just a little bit overwhelming at times as well. So I just feel like, you know what, if people aren't going to be respectful of the work that I'm sharing with them for free, then I don't really need to be bothered to post there as much.
Well, I think that everyone who's in the public sphere feels that way, Michael.
Yeah, and I just, more broadly, I get annoyed because, 4 weeks ago when the market was tanking, there were a lot of people who just kind of vanished from the realm, and now they're out running themselves as if they called the bottom, and it's a really difficult. I think it really shows you, I think, what a lot of people are on this platform for, which is really just creating their own, generating their own self-interest and pushing an agenda. So anyway, I've kind of,
Michael, I actually think there's, that you know, after COVID and everything, that a lot of people have PTSD from it, and it's almost a channel for their aggression and
Right.
anger. There's a lot of anger in the country. You
Yeah.
know, if you're not the 1%, you're not cleaning up. They're saying inflation's coming down, and wherever you go, it doesn't seem like it's going down. And
Yeah, no, I mean
people are
it's not.
being squeezed. You know,
And
they're
it
being
and
squeezed.
that's the problem, is that it's really not coming down. And there's this, you have, like you were just talking about, oil prices, and you have energy disinflation, which is really sort of uh masking some of the underlying weakness in prices. And then you have these stupid metrics that the Bureau of Labor Statistics doesn't know how to calculate, like health insurance. I mean, these antiquated ways of going about calculating an expense that's gone down for nobody, but yet, the BLS thinks it went down 37% last year because they look at retained earnings. I mean, if you look at a chart of UNH, I can tell you that health insurance seems to be doing quite fine.
Okay, interesting. You know, I want to start with the S&Ps because on your feed you talk
Yeah.
about easing of financial conditions, which forget this 4 hour stuff. Let's take a look at the daily. So this rally from late October was took place under easing financial conditions, right?
Yeah, exactly. And what I think people miss about this rally, I woke up this morning and I kind of woke up in a bad mood, I guess, because I saw the S&P 500 was up 40 basis points. And the reason why it annoys me, like today, like days like today, is that if you look at Asia, it was absolutely hammered last night. And there was really no news out overnight that should have resulted in this overnight ES pump. And Germany is up now a little bit, moving up as well after the weaker than expected CPI numbers. But I mean, Hong Kong is just getting obliterated every night. South Korea, even with its short selling ban, can't catch a bid. Taiwan, which is very, highly correlated to the NASDAQ 100, hasn't really been performing all that well. And when you look at the rally off of the lows in October, it was a totally mechanical rally. I don't know if you remember the last time I came on. I think the S&P 500 may have been right around these levels, and we were talking about the relationship between the S&P
Canadian
and
dollar.
the Canadian dollar, and how I said that I thought we
Yeah.
were going to go right back to 4,100, which is exactly, what happened. The Canadian dollar went up to 136, 137. The S&P 500 gave back all the gains. I think we're actually in the same exact position as we were then. It's just
Really?
that you would never know that we fell 10% and rallied 10% in between the period.
All
And
right, so
essentially,
you're saying that easier monetary conditions, which drove up the S&P, is going to be responsible for a retracement of the market because they eats too much. So, are you
right.
talking about that? When we hear Powell in a few weeks, he's going to walk back
Well,
a lot
he's
of things.
talking on Friday He's talking on Friday, actually, at 11 a.m. And the thing is that my analysis shows that when financial conditions ease, it tends to hit the economy within 6 to 9 months, right? And so when they ease too much, what it tells me is that we went through a period of tightening, right? So we're likely to see some slowing in the fourth quarter. But I think what's going to happen is that you're going to get another reacceleration in the economy come March, because financial conditions have been easing. And I think the tough spot for the Fed is that if financial conditions ease too much, you're going to find yourself in a situation where conditions are too accommodative, and that's going to allow inflation and the economy to really start reaccelerating again.
Do you
And
think Paul cares about gold being over 2,000? Do you think Paul cares about that perhaps a dollar is broken down? And, I want to get to this because this was part of the catalyst for the rally, a huge part of the catalyst. So, let's go TLT. And I want to acknowledge that when the TLTs were up here and trying to hold, you said you were looking for one more decline, and it was based upon Prechter's work, actually.
Right,
How
right,
do you
right.
like my memory? All right, so
You always remember everything.
all right, so we did. We went to 82, and this was wave 5, and we've had this recent rally.
Right. And you
Do you
can see
think
the
there's
rising wedge there, right?
Yeah, I mean, if we get a pullback to 86, I would consider buying it for another wave. Do you think this is just a temporary reprieve in the bond market and we're going to make new lows, or there could be a pullback and then another advance?
So right now, what I'm actually beginning to think about is that we probably have seen the area in which bond yields have peaked, right?
Okay,
That
yeah.
This 5% area on the 10-year is probably going to be the area where we peak. I think we're probably going to be more range bound in the 10-year and the 30-year than we're likely to see a big decline in it. Meaning, like, I think we're going to stay somewhere between, let's say, 430, which is 4.25, which is the October 22 high, and we're likely to stay between 4.25 and 5%, right? And so if you look, October 22 was around 430, I think. And if you notice, we're making
Yeah.
some sort of reversal candle today, at least if these numbers,
Yeah.
Hold up. Certainly treasury auctions have been pretty horrible, right? And so that issuance is gonna keep some of I think
There have been some
softness.
good auctions. I think Santelli gave some of these auctions Bs and As on bid to cover recently.
Right. Yeah, there have been some decent ones, but the 7-year yesterday wasn't so great. The 30-year 2 weeks ago wasn't great at all, right? So I think there's been a mixed bag in terms of the 10-year tip auction last week. I thought was pretty bad as well. When you look at indirect demand coming down, when you look at the tails on the auctions have been pretty wide. When you look at primary dealers getting stuffed with a lot of these treasury issuances, they just don't seem to be. There seems to be so much of issuance coming that I think it's going to keep the bond market a little bit soft on the back of the curve. Additionally, you're not seeing enough economic data to really suggest that you're going to go into a recession at this point, I think, really to push the back of the curve down. But what is clear to me, which I think is really the most important part, is that the front of the curve is starting to come down, right? And I think that's really the part of the curve now that's going to drive a lot of parts of the market. And essentially what I think we're going to start seeing is, the yield curve has been inverted for a very long period of time. And I can share with you my chart.
Okay, let me stop sharing and you could share.
Oh, I can't.
At the bottom.
I can do it. Yeah. So basically what I've been watching now is that the S&P 500, which is in yellow, it's inverted, right, has basically been trading with the curve. So when the yield curve goes up, the S&P 500 goes down. And you can see that was pretty much the case, and it's still been the case up until yesterday. You can see there was a pretty big move higher in the yield curve the last 2 days now, but the S&P hasn't yet responded. My expectation is that you will see, if the curve continues to steepen, you're going to see the S&P 500 move in the direction of the yield curve, which will be.
So I think a lot of people don't know it. So let's clarify it. So while the yield curve was inverting and people were talking recession, the market thrived. Okay.
Correct.
And now that we have a steepening or an unwinding of that, the markets are going to suffer as
correct.
You have a steepening of the curve. It may be good for banks, but it's not good for the economy.
Right. I mean, essentially the way I think the mentality of the market worked from, call it, the middle of last year and then even through SVB, was that an inverted yield curve meant that recession wasn't coming yet, right? So a lot of times people think that inverted yield curve means recession, right? It means recession, but it usually means recession 18 to 24 months later. Yeah. It's when the yield curve starts to re-steepen that you really have to start worrying as an investor, because that's really, and it's the manner in which the yield curve steepens that really matters, right? So the first half of the re-steepening was in the form of the 10 moving to the 2. I think the next part is going to be about the 2 moving to the 10. So the 2 moving down. And that's going to be the signal that we are heading towards some sort of economic slowdown, some sort of economic potential recession, I think sometime in the first half of 2024. And I know that the consensus was last year that we were going to have a recession last year. It never happened. Last year, my view was that we weren't going to have a recession, and instead we were going to be in this sort of stagflationary environment where we had this slowing growth rate and higher and a rising unemployment rate, which we have the unemployment rate that's rising. And certainly the first half of last year, we saw some stagnation, but then the third quarter reaccelerated.
Well, it seems like the market has completely embraced the soft landing. And I heard a comment from David Rosenberg, who said that's just part of the cycle. The soft landing is a transition from growth to slower growth, and you always have a soft landing prior to the contraction.
That's correct.
Okay,
I mean,
right.
That's absolutely right. I mean, you're going to have a soft landing before you have the hard landing. And and look, I'm not advocating here for like a 2008 type of recession. I mean, this could be a 2000 type of recession where it's, soft and we see earnings contraction, and it's enough to reset valuations and multiples on stocks. But I think what's important here is that if the yield curve is re-steepening in the form of the 2 moving down to the 10. I mean, the yield curve has been inverted for a very long period of time.
Couple years?
It's been inverted. I mean, if we go back and look, it first inverted really July of 22. I mean, it touched it in April, but then it snapped back. I mean, so we've been inverted now for almost 18 months, right? Okay. Yeah. Which is a fairly long period of time. I mean, if you go back and look at some of these other periods, you can see this was 546 days. This was 336 days. This was 595. I mean, if we just look at from when it was inverted, back in July, we're right now at 504 days. So we're in this
in the zone
ballpark where it's time for the yield curve really to think about steepening again, right? And seeing that part of the movement from the 2 to the 10, because look, as inflation slows, the Fed is going to have to cut rates. It's not about what the nominal Fed funds rate is, it's about what the nominal real Fed funds rate is, right? And if inflation keeps coming down to the 3% number or 2.5% number, and the Fed funds rate is at 5.5%, and you're at 3% on inflation, that's a 3.5% real Fed funds rate, which is extremely tight, right? So in order to keep that Fed funds rate in that 2.5% range, the Fed's going to have to cut rates to keep that real rate from being too restrictive. Otherwise, actually, as inflation comes down, if the Fed doesn't cut, policy will become more restrictive, which is the piece that people really, I think, miss. Is that as inflation is falling, policy is actually becoming more restrictive by the day because the real rate is rising, which is why we have real yields across the curve over 2%. And so the Fed is going to naturally have to cut. The question is, how much does the Fed have to cut? And if we see the 2-year rate, which basically trades with Fed fund future contracts, from a technical standpoint, the 2-year looks like it's breaking down, right? It's broken some key support levels here at 4 3/4, which I think sets up a move potentially to 450, right? But I think what's really important here is that when we look at the Fed fund future for December of 25, which is about a year from now, the 2-year rate is essentially trading with this contract at this point because it's only about a year away. And you can see that as the market prices in rate cuts, the 2-year is trading along with it. And so I would think that as long as the market continues to anticipate lower Fed funds rates, you're going to see the 2-year continue to decline. And this spread over time should begin to contract a little bit. Because if we look at 2024, you can see that it was the same exact case. And 2024 is only 1 year away now.
Okay,
So I
let's
think
get
that we're going to.
Go ahead.
So I
Finish
think
up.
we're going to see the yield curve continue to re-steepen in the form of the two falling to the back of the curve. And essentially, I think this is what's going to be, sort of a major problem going forward. Because I have another chart here I can show you, which I created, which I call the 210 curve 18-month forward. And I'm basically taking a 2-year forward rate and a 10-year forward rate, and I'm creating a 10-2 curve out of it. And what my analysis shows, it doesn't go back, I don't think, far enough to really make it statistically significant, only because we've only had 2 recessions during this period of time, or I mean 3 if you count the 2020 COVID one. But what you see here is that it's when this curve becomes positive and then really starts to steepen, that's when you have, the equity markets really start giving back. So in this case, the curve was negative 50 basis points in 2000. It rose about 50 basis points. That was when we really started seeing, the equity market selling off as the recession really became the case. In this case, we never got to zero. It never got below, but we went from about 10 basis points to 50 basis points, which was a rise of about 40 basis points. And that marked the top again, but it was about the curve continuing to rise. Now, at this point, we've had, some back and forth here with the curve. But you can see that at least since this point here in July, we've gone up about 50 basis points from bottom to top, and about 30 basis points from this point to this point. So my feeling is if the curve continues to rise from here, that you're going to see the S&P 500 turn lower and trade down as the market begins to worry about a hard landing.
Okay. I noticed it seems like you're still constructive the dollar, Michael. I turned negative after that CPI took out 105. I like the whole world changed a week ago, and I'm just hoping for a little pop in the dollar to buy Aussie dollars and buy euros. You're still constructive the dollar here?
I'm not. The dollar is sort of difficult for me right now because when I look at the euro, it's kind of hovering around this 61.8% retrace level. When I look at the pound, it's still in this area where it's about 50-ish% or so. Maybe a little more, 61.8 it hit actually today. So I'd
buy a pullback in cable, I'd buy a pullback in euro, some type of retrace of their rally, like euro 104.5 to 110.
The problem I have though is that when you look at this pattern, right, it first of all, this was a new low versus this, and this looks like a very sort of impulsive rally down, which tells me this is probably your 5-wave structure. This is probably your 3-wave retracement. So this could very well be a 1 and a 2. Right, which means that you get another leg down. And I think the problem here is
would that be normal reaction of the dollar with your interest rate narrative?
That's the thing, right? If we go into a recession, you get a flight to safety. If the U.S. is going into a recession, chances are Eurozone is going into a recession, if not already in one. And you probably think that the UK will be in recession too, which means that the dollar should actually still outperform the euro and the pound. The one that I'm not bullish on though is the yen. I think the yen I think the yen is going to strengthen versus the dollar from here. I mean, you have a nice potential double top pattern. We know the BOJ is going to have to do something in terms of raising rates there. So I think that the odds favor the dollar continuing to be strong against the euro and the pound, but I think it's going to also be fairly weak against the yen. I think your idea about the Aussie dollar may have some legs, and the only reason I'm suggesting that is, it looks like you have a nice sort of bottom process here. But more importantly is, look at a couple of the key gauges that go into China, the Baltic Dry Index, which measures, freight rates and things of that nature.
Turning.
I mean, it's turning pretty materially, right?
Copper is too, right?
Yeah, when you look at iron ore prices, they've started to rise, although they're a little bit weak. We have to wait for a breakout here. And then you can see gold, copper is breaking out, I think, as well. And, if you get a breakout in copper, you get iron ore prices moving up. I think that's a positive sign because I think that's more China related. That's obviously going to be positive for Australia and any sort of exporting commodity-based economy, which could mean that the dollar, weakens against some of these commodity exporters like Australia, like Canada, like, I don't know, some of these other emerging markets, like maybe Brazil.
Okay. So looking at, so we've covered the dollar. Really the star of the show has been gold and silver. And, I tell people, now I wouldn't chase it. But it does look like we're set up to take out that triple top. It almost looks like a layup. Do you think that we'll have some type of pullback first, or are you bullish?
I was actually doing a Zoom session yesterday for someone else, and someone asked about gold, and I said to them yesterday, it looks like gold to me for right now has put in some sort of short-term top. So when I look at things to be overbought or oversold, I have a criteria where I look for the stock commodity index to be trading over the upper Bollinger Band and for the RSI to be over 70. And right now you have both of those conditions. And so what that tells me is that right now this is a point where you're likely to see either gold pull back, maybe back to this 20-day moving average, or you're likely to see it just consolidate and trade sideways. I think if it consolidates and trades sideways, it's a very bullish indication that gold is going to probably break out and move higher. I don't really know what that means for inflation, because obviously if you're seeing things like gold and copper and silver moving up, that could be an indication that inflation is not really completely going to go away. And in fact, I've been mulling and thinking about just buying the GLD for my portfolio, because it seems to me in this environment, in this world, something has changed with the structure of the economy here in the U.S. and abroad. And I think it's mostly due to I can show you, I don't think enough people focus on this, but U.S. employment rate, labor force. Let me just see if I can find the chart, and then I'll.
So really, Michael, when you really look at the broad picture, everything rallied. It's all, if the dollar is bad, everything goes up. At least
that's financial conditions.
Okay, so I'm looking for a bounce in the dollar, to sell into, right?
Right.
If I want to try and buy euro at 107.5, 107, maybe I'm dreaming. But if that happens, you would think that we'd get an S&P correction, at least to correct the advance from 41 to call it 46. Could we get just a pullback like to 4,300, 4,350 in S&Ps?
Oh, I think that's certainly possible. I'm actually looking for the whole thing to disappear.
The whole thing. Okay.
Yeah.
Well,
you
if
can
we
see
take
the dollar,
out 41, we take out 4,100, it's game over.
Yeah, my numbers around 40.50 is the level that needs to really hold. That was the level that I had noted in October, that the S&P, when it got to around 4,100, was oversold, and as long as we held 40.50 to 4,100, we were going to be okay. But if we broke that 40.50, 4,100 level, I thought there was problems. But you can see here that the dollar right now 61.8% retrace, and it's bouncing at this point, right?
Yeah.
So if you start seeing the dollar, moving up along with a yield curve steepening, I think that's going to really send a message of a little bit of a flight to safety sort of growth scare warning. But what I wanted to show you was this chart. This is a chart of the people not in the U.S. labor force, right? Do you notice anything here?
You mean the spike and then just sideways?
Yeah.
Yeah, I noticed that.
I mean, what this shows you is that basically 5 million people left the labor force after COVID and never came back.
Never came back.
They haven't come back. I mean,
Yeah.
What this is sort of telling me is that there were people who were on the border of retiring, and they decided to retire and not come back. And this has created a labor shortage. And this is why you've seen wages increase. This is why,
unions are getting their deals.
Right.
Yeah.
And so if you have a shortage of 5 million workers in the economy, and by the way, it's probably not coincidence, right, that the JOLTS went up. If you look at the JOLTS data, the JOLTS was around, 8.3 million going into COVID, and then it peaked at, about 11 million, right? And no, I'm sorry, I'm looking at the wrong scale. It was at 7.1 million, and then it peaked at 12 million, an increase of 5 million, right? So the 5 million that left led to a 5 million increase in job openings, right?
Yeah, right.
I don't think that's a chance. I don't think that's by chance, right? And so what this is telling you is that there's a hole in the economy of 5 million workers. And as long as that hole exists and there's that imbalance, then you're going to have this sort of wage pressure that's going to remain, and that it's not going to go away because there's just not enough workers to fill all the open jobs. And that's going to sort of keep this inflation in this 3-ish to 4% region, because that's where your average hourly earnings have essentially been now since we've kind of come down. Was there, I guess, a big revision, I guess? Did I miss that?
So is this going to be, it sounds like a replay of the 70s where the Fed had to go at it, I believe, 3 different times of tightening regimes. And
Right.
that we've seen the first, and now there's a pause because, Powell's taking victory laps at his last presser, and that they're going to have to come back and do it again.
And again, if financial conditions ease too much, that's exactly what's going to have to happen. And I mean, when you look at the S&P 500 in the 1970s, I was not born I was born in the late 70s, but I don't know. I mean, you had a series of basically just rolling, bear markets and bull markets, right? I mean, you remember. You're a little older than me, I guess, but
yeah,
I mean,
until 82, and August of 82 was the beginning of the prolific bull market.
Right. And essentially, I think what we're setting up for is something similar to this, right? Where we're going to be in a market that is going to go nowhere, right? That maybe we're in this 3,500 to 4,700 range for the next few years. That's what I think we're in. The same exact thing happened in 2000, right? And if you look at the market over a period of time, right? If you go back to the 1910s, right? I don't know how far back this chart's going to go, but if you go back to 1910, I mean, you have this sort of period in time where we had the big 20s, then we had the big correction, recession, depression. Then we had a period where we did nothing. Then we rallied. Then we did nothing. Then we rallied. Then we did nothing. Then we rallied. And now we're due to probably do nothing again, right? Where you have these periods, you go back, this is 1962 to 1982, 20 years. You have basically the year 2000 to the year 2013, call it 13 years. Now you've had 2013 to 2022. Maybe you go through another period of 5 to 10 years of nothingness. Why would that be so hard to imagine?
Yeah, so it's going to be important to know how to be tactical.
That's what I think. And I think that what I've been thinking about is not only, this is a type of market I feel where you have to be aware of a lot of different things going on, but I think fundamentals really matter, because this is a type of market where if you understand the underlying fundamentals, you'll know when the valuations have gotten to be too low, and you'll know that when the valuations have gotten to be too high, because essentially what this market is the way I'm thinking about it is that I want to be a buyer of the market and, individual stocks and individual names when the index is coming down, and I want to be a seller of it on strength, which is, essentially what I've been doing now for the last 18 months, right? So like right now, for example, I'm not doing anything because this market's at the upper end of the range, and I kind of raised the amount of cash that I want to hold. But I mean, if we look at this, right, we're right back around the upper end of the range here. 21 was where we peaked the last time. And if I look at it from another perspective, if I look at it from I think if I did a blended PE 12 months forward, again, you can see that, we're at the upper end of the range in terms of valuations. You have to forget about this. This was an anomaly, I think, right?
Yeah.
And you can see we're back up to this 18 area. 20 was the July high, which seemed too high. And, if you're in an environment where, inflation's likely to stay high, the corporates are likely to be in a position where they're going to see wage and labor problems. It probably also means that, S&P 500 earnings growth for next year is too high, that margins are going to have to compress more, that you're not going to get 10% earnings growth next year, and that you're likely to see valuations and multiples contract. So I think all of this stuff just goes hand in hand. And and going back to the shorter term, because I guess your audience is probably more. So the reason why this whole rally happened was because you had two things happen. The market got very short gamma in the October lows, and then the S&P gamma positions were very net negative, which created this sort of violent face-ripping rally off the low. Then that triggered, the systematic funds to go from being short the S&P 500 to having to go long the S&P 500, which created the second wave up. And now we're sort of at the end of it. I no idea why the S&P would be up this morning. And with the yield curve sort of steepening today, I would be very wary of this move that we're seeing in the pre-market. Because again, what we've typically seen is that, the S&P.
I'm with you on that, Michael.
The S&P 500 tends to trade with the direction of rates and more importantly, the direction of, the yield curve. And so, we'll have to
time will tell, and I don't think it's going to be that long.
Right.
Or either we're going to blow through 4,600 or we're going to get that pullback. And Michael, I'm getting a comment from Ingmar. Thank you, Michael. Great interview. What's the best way for people, since you're having trouble on Twitter, let's get people just to subscribe. So what's the best way to follow your work, Michael?
Oh, so you can just go to my web. So I have Twitter, obviously. But I also have my website, My Capital Management, which I'm taking you to I just call it the Market Chronicles. So you can get all my stuff here. I put out a daily commentary for free. And then from there, you can get access to like a lot of my subscription service. I list articles that I'm writing for there. And I also have a Substack as well, where I also publish this as well. And I have a following on Seeking Alpha too. I write here as well, and I have a subscription service. So all of my content is pretty much divided up into Substack, Seeking Alpha, or my own website. So that's pretty much where you can find me.
Okay, Michael, and you do great work. Keep it up, keep your chin off, and shake the dust off your sandals when people are giving you a hard time, buddy. And I guess we have to have thick skin to do what we do and, take risk, all of it. Appreciate you being with us and sharing your work, Michael.
I appreciate you taking the time to come on.
Yeah, I'm a fan and I'm rooting for you. And
thank you.
Look forward to talking to you this winter. when the snow was falling somewhere.
I'll
All right.
have to change my background.
All right, Michael Kramer, everybody, check him out at Mike, and it is a Market Chronicles. Don't get it confused with the Martian Chronicles, right? Okay, so Michael's read that too. Everyone have a great day. You could join the team in 6 minutes on the Morning Edge. Don't forget, don't just count your pips, count your blessings. A lot of people can't afford to take risks. They're deciding whether they should buy food or pay their rent. So consider yourself in great, really, you're blessed to have money to lose.
That's right.
I'll see everyone tomorrow. Good hunting, and thanks again, Michael. See you,
Thank you,
brother.
Dale. See you soon.
All right.